Good afternoon. This is Kevin Baker, Bakes Takes. Welcome to the show. It's Saturday, November 20th, and I'm here to make you money in up and down markets. Yes, stocks do go down. And please do me a favor. Please refer one person if you think I've added value. I really want to add to my subscribers, and I appreciate it. Thank you in advance. Why I do this, my boys, Bobby and Jack, now 25 and 23. We talk money in markets. This is a great excuse for me to stay connected, and I invite you to listen in. I am not a shill for the hedge funds, as some of my Twitter friends have opined, and my YouTube friends. I simply want to make money for my sons, again, in up and down markets, and I invest accordingly and only talk about what I'm interested in and investing in. So I have no extra grind, except that I want to help myself and my sons and make money for my wife and I. I was a broker in the 87 crash, went through that crazy year and day, and I found technical analysis, charts, patterns, volume, and I do a lot of fundamental work, which you'll see and have seen, but I go technicals first, fundamental second. It just works for me. It's not right or wrong. I read the Journal, Barron's, The Economist. I listen to podcasts. I devoured relevant newsletters. I monitor what my Google alerts bring, and I point you to them. But if you don't want to do that, please know that I'll do it for you, and I eat home cooking. I have no conflicts. And tell me what your pain points are, problems you'd like solved, topics I should cover. And thank you. Thank you especially to my sons, Bobby and Jack, and Charlie, Justin, Murph, from this Luddite that's making this show better and better and better and more technically savvy as we go forward. I am going to launch Bakes Takes Plus using Supercast or Patreon or something along those lines, where it's going to be more tailored to you and your stocks and your ETFs and your funds, even more than I do now. Maybe a weekly call with me, either on Zoom or Discord. I'll teach technical analysis. You help me design the show. Tell me guests I should reach out to, texts I should send. And I send text to my sons whenever I do a trade. You want to be on that? 610-331-4283. This is not investment advice. Here's my disclaimer. Please conduct and share your own due diligence. And fan mail, which always makes me happy. This is Basil, a new friend of mine, and asked about MP materials, and a short report came out. I'm paraphrasing the question here. Whacked the stock down 12%, has since recovered, and he's in at 37. And Basil, here we go. Here's the chart. And those of you who are listening, please go to my YouTube channel so you can see the charts that I referenced, because I'm a visual learner and teacher, and I hope this is helpful. Now, my thought when short reports come, whenever someone like Off Wall Street or someone of that ilk issued a short report in my prior life, it made my life miserable. Frankly, they were usually right. The work was very thoughtful and layered, and I'll go into that a little bit more. In this case, the earnings pleased the market. Right after the short report, the 50-day moving average moved up through the 200-day, and it looks good. So I would say hold for now. Grizzly reports, I don't know them, but I do know the way shorts work most of the time, and they keep coming in waves or layers, and there's always other arrows in the quiver to shoot over time that they usually have saved. So, and I've read the report briefly, basically saying that Chamath has repackaged an old rare metals company with no little change. And I have not done the nitty gritty fundamental work that I normally would have in the old days, but I hold Chamath in high regard. I don't know him personally. I do think EVs are overhyped. I think the competition is going to be brutal and ruthless. But anyway, this broke about 40.68 on big volume, which is a positive. And especially if it continues to shrug off subsequent bear reports, I would hold the name. 51.77, you asked about levels. 51.77 is the old high. That's where it stalls out, I think, and consolidates another base. But if it blasts through that, then Katie, bar the door. So my take is hold for now. Execute my sell discipline if the future short reports don't knock the stock down, and the 200-day moving average is at 34.79. That's the first time I'd be getting nervous, and that isn't too far from your purchase price. So I think you're in pretty good shape, and I hope I've been helpful, and please tell me if I haven't. I had an anonymous request asking about how to invest in private companies, and I'm very public company focused. I like having a chart with history and volume that I can pay attention to. So I'm not going to kid you. I have done very little with privates. And so you asked about different legal structures, SPVs, special purpose vehicles, LLCs, limited liability corporation. And I'm just going to admit when I don't have really an axe to grind or an edge, and I don't have one here. So now I would ask two things. Number one, if you're going to be in privates, I would certainly diversify away from your main line of income. So if you're in the financial industry, then I would try to run far afield and be away from where you earn your paycheck. So be in everything but financial stocks or companies. And then second, check out Jason Cal. Make sure you have the liquidity. Make sure you have that base of cash, gold, crypto, so that if all hell breaks loose, you have some liquidity to meet your living expenses. And I would check out Jason Calacanis, JCal, at Jason on Twitter. He's the host of the All In podcast, which I talk about all the time, and This Week in Startups, which is terrific. And angel investor, written several books, and it would be a good place to start. And I hope that's been helpful in some way. Anthony Kulicki, I hope I'm pronouncing that right. Anthony, our meeting has great show. Do you think the oil services sector is still undervalued? Do you have a favorite from just looking at the charts? I've been nibbling on rig, and yes, I've been long uranium stocks for months. I love the sector. Thanks. And I thank you, Anthony. I really appreciate the kind words. And you brought a smile to my face with rig, Transocean. It was the first oil service company I bought back in the 90s. Yes, that's how old I am. And I had to ask what a day rate was, which is, as you could have figured out, it's what they charge the oil companies per day to drill a well out in the Gulf of Mexico or wherever. And so this was a really good winner in the 90s for me. And now I'm going to have to say it's fair at best. Take a look at these arrows. The volume is picking up on the down days. The moving averages are crossing to the downside. And I don't think there's a lot going on here right now. Here's the longer term chart. I wanted to bring this up from 2008. And this is just, I got a couple of points here. I mean, obviously, these are cyclicals. They can be great stocks, but stocks do go down when fundamentals change, and they anticipate fundamentals. So this peaked at 163 in 2008, and it's so old the chart doesn't cover the time I owned it. I can't go back that far, but then we bought them in October of last year at 65 cents. 65 cents. So if you don't have a self-discipline and you ride stocks down, it can be really, really painful. And I'm sure there were analysts at the peak that were declaring the sound fundamentals, shortly after the peak. And I'm just here to tell you that things change, and you have to be agnostic about stocks and shoot them when they turn into old yellers. And rig turned into an old yeller, and I don't think it's turned around yet. It's bounced off the low, but I don't see anything great going on here. I'll talk about that a little bit more. So my take is wait for rig to break out. And this is another great point. The stock will tell you and us if revenue and earnings upside is coming. You don't need to anticipate it and then get into something that's dead money, or worse, loses you a lot of money. I like the market to tell me what's coming up. By the way, I'm doing this now, and I'm going to do this for the premium service. I take all these ideas, I put them in my system, and I go through them, virtually daily. And I'll let you know if something is going on that I think is actionable. And you can make your own mind. You're big boys and girls, and it's your money. But I'll say, hey, this happened at this price. The volume looks good, bad, or ugly, and I'll let you know what's going on in real time, and so that you can hold your winners and let your winners run and cut your losses. So I looked at the general oil services sector to see if anything was going on here, and this is the OIH ETF. And the bottom line is, this is my fundamental thoughts. The E&Ps won't expand their budgets and start spending money on drill bits and oil rigs and all these other things that need to get oil out of the ground until their stock goes up. And they've said that publicly. Jeff Curry at Goldman Sachs has been talking about this for a long time. He's the head of commodities there. And I believe him, and I'm seeing it in the charts too. So this is a mediocre chart, in my opinion. And I would stay tuned. I'm going to be looking at this and I'll let you know if I see anything. But for right now, I don't see anything going on in oil services sector. And if anything, I have a bias to that because it worked out really well in the 90s for me. So here's the oil services sector ETF longer term. This is the monthly OIH. Started at 08, it was at 1,524, and came down to 66 last year. So stocks go down too, and I'm going to be here, helping you along the way. Here's the oil price going way back to the 30s, 40s for more perspective. In 08, there's that theme, and that was the peak for a lot of things, stocks included in general. But oil peaked at 170, and then I think it sniffed out the financial crisis. That's just me. Bottomed at below 20, and we've gone from 20 to 80 in the last 12 months. And energy service stocks don't really care yet. And so, the market's pretty smart, and it's saying, I think what I've relayed from Jeff Curry, my take is it's too soon for oil service, and I'll let you know when it changes. So I hope that's been helpful. Murph asked about SOXX, and we've talked about this in the past. This is from a recent show. And I do this because I want to be honest and keep my feet to the fire and tell you what I do right and wrong. But this is from, I don't know, 3 weeks ago, maybe a little bit more. And I mentioned, this is right from my show notes of that time. Big down volume is a warning sign. It's still respecting the 200 day at 434.54, but it feels and looks tired. And my take at that point was the NVIDIA and AMD earnings reports will tell us if there's enough to keep the bull going. I doubt it, but hold this winner for now. Well, Intel had just had a horrible earnings report and created that test of the 200-day moving average. And then this is more recently the SOXX went from 463 to 531, up 14% plus. So there was obviously a lot of good things going on outside of Intel to push the general group up. Now, and Murph, you and I texted back and forth on this, and I said, you asked about the SOXX, I said, NVIDIA is a beast. And it went from 200 to 300, 50% in a month, and more than made up for Intel. So, and oh, by the way, the Thursday, Friday this week, they blew out earnings and it went up another 10%. So, the market did a great job of saying Intel's bad, but NVIDIA and AMD are good, and this is going to go north. But notice what I said. I said I doubted it, but I said hold it. And so, I try to check my biases at the door as best I can. And NVIDIA, even though it's a great company, even though it's very expensive, it just got more so. And I'm not going to argue with the market. So hold on to SOXX. Great pick. Congratulations. This is also from a recent show. This is DraftKings. And again, this is the kind of thing I want to do in Bakes Takes Plus is, everybody cares about their stocks more than my stocks. So I'm going to be talking about your stocks, and I'm going to try and get you out of harm's way and maximize profits. DraftKings, DKNG. The arrows I drew here were my sell discipline. I won't go into that here unless you ask me to for a future show. And then we got out at 46.52, or that's what the sell discipline dictated. And the down volume was 63% above normal. The earnings were coming up in 14 days. And what did I say? I said, I didn't like it. Is making a long story short. And so we went from 46 to 39, down 15%. Earnings didn't drive the stock up. What will? And I think that's still the case. My take is it's still in a void, and I'm happy to discuss down the road. From another recent show, this is Square SQ, and these are from my show notes again in the past. closed below the 200-day moving average, big volume. I would have sold a third. I said it's a great company, but it's a great company with 144 PE. And that's expensive. I don't care who you are. And so what's happened since then? That's at 248. And now here we are subsequently at 237. It's not, horrendous, but it's clearly rolling over. So my take is I would still avoid that. Peloton, folks have asked about in the past. Big fans of the product, but don't be, lulled into thinking that it's a good stock as well. So the sell discipline said get out at 105.53. Please take a look at the three arrows here. And we're at 55.64 now. So if your fundamental work got you out at 150 at the peak and you top ticked it, great. I doubt that happened. It almost never happens. But if not, 105 beats 55. And my caveat to this is Scott Galloway and others have talked about Apple being a very likely acquirer of them. So that to me, that's about the only event that's going to move this stock up meaningfully. And I think also you're going to have tax loss selling that's going to be a problem as we go forward over the next 6 weeks, basically. Peloton, this is the longer term, which I just want to show you the perspective. The breakout was at 37. We went to 150, and then it's easier to destroy than build. So we went from 86 to 55 in one day, down 35%. And now that line is resistance. 68 to 80 is pretty strong resistance. Anytime you get close to that range, there's going to be a lot of selling coming. So I would be very wary of that. And here's Peloton now. I think 50 is the floor, and it's dead money for now. They just raised $1 billion. They're losing money. But this is a good example for Bake's Takes. I'm going to monitor your stocks, ETFs, funds, and alert you of buy and sell points. And then you do with them what you will. But I think you're going to find over time, like those last 2 or 3 showed, I'm pretty good at this, and I've got an eye for this after putting in my 10,000 hours. I'll help you lock in profits and avoid losses. And tell me what else you'd like too. Charlie S came in and asked about Fidelity Trend, and this is a beast, Charlie. It's mom and apple pie. That this is the top 10 holdings that I just printed here to show people: Amazon, Google, Facebook, Nvidia, Tesla. It's a murderer's row. And so now it's stretched and extended and expensive, but just let it go. Just let it ride. Same with Fidelity Founders. It's in a clear uptrend, way above the moving averages. Again, mom and apple pie kind of stocks. And so my take is hold both. These are expensive leaders, but they're still working. So if this is long-term retirement money that you're dollar cost averaging in over and over and over again, especially at your age, just let it go. Just keep going. If it's more speculative additional investments on top of that, then I would watch the moving averages and my sell discipline, but you don't have to worry about anything right now. And again, I've plugged this into my system, and I'm looking at it in my alerts all the time. My themes and groups. And I have this thing in my phone that I look at every single day, and I go, what if it works? Because the traditional way of managing money really doesn't work. The healthcare analyst pitches stocks. That was me. The retail guy and the tech lady, and they go to the PM and they say, I think we ought to own these. They're in the benchmark, and we're going to outperform the benchmark. And as we've seen over and over again, very few people are beating the benchmark. In fact, most are trailing. And the fees are coming down, and the assets are going down, and the firms are imploding. So I said, wait a minute, what if you just become your own hedge fund and just go wherever the heck you want and try to make money every single year in up and down markets. Yes, the markets go up 70% of the time, but the 30 hurts. And so I'm trying to make you money in the 30 as well. And we'll see if I can do that. All right. We don't really know yet because it's been straight up since we started. But here's my portfolio, up 18%. There's no 15% losers. Uranium is up 213% since the July 25th buy. It's up 123% year to date. Uranium is still acting great. URA. Copper, COPX is still working, up 23. You can see everything here. Agricultural stocks up 22%. The retail stocks, including GameStop, as a percentage in here. I think it's 4 or 5, is up 14%. I'm short the SPACs, and I'm short emerging markets, especially China and Taiwan. And those have hurt, but not much. I'm down 2-3%. I've got 35% in cash, so I'm nimble and I can go to the next uranium when I find it. And I'm always looking for it. And if you can help me, I am all ears. Murph asked about uranium and the 70 URNM, in this case, North Shore, the 7178 level that I talked about, is that still a place to get in? And I said yes. And I drew on the chart here the breakout of 71 and the stair step that we're building here. And then I wanted you to see, people can say, what makes a good chart, or what are you looking at? And I hope this helps to an extent. I see stair steps here. They're imperfect. They're not, exactly the same size, but this is what I want to see. I want to see a step, a breakout on big volume, a consolidation, build another step, and keep going. And they're imperfect. They always are. But what I think is happening here is we're building this next step. I think 71, 78, I doubt we hit that range. I think everything's possible, but we're building a new base, in my opinion. And I would have maybe a third to a half of your position just now at 92.3, something like that now, because I want you to own it, because I think we're in inning 4. We're not in inning 8. And just for perspective, the metal itself, these are the mining companies, but the metal itself is gone from 18 at the low to high 40s, low 50s, depending on the day. The prior peak was 130. And I don't see any reason why we can't hit that again, which is why I talk about 5 to 8 times so much. And Murph, I hope that's been helpful on uranium. The agricultural complex is still going, especially wheat, which is 25% of this. This is TAGS, the Tellurium Agricultural Fund. And the trend's still intact. Wheat's over $8. Inflation is here, and it is unlikely transitory. And this is the market telling me and us, and it told us a while ago, that this inflation was coming, especially in the agricultural products, the SOXX as they're called. And so I would still be here. It's acting, frankly, better than I thought it would. So my take is hold uranium and TAGS for now. 10% of the portfolio of each is enough for me, but you do what you want. But that's what I'm seeing, and I really appreciate the question. I went through all my charts this past week, 1,700 plus, like I always do, including yours. And this is the only thing that came out to me, or reared its head, was the S&P 500, and this isn't a big deal yet, but it's a small concern. The price is going up, which is great. That's obviously the most important, but the volume is receding on the down days. So you can see the arrows that I drew here, and it just means that I'm a wary bull. I'm a bull with his head on a swivel, and this feels tired to me at a time of the year when it shouldn't be tired. We just had great earnings reports, and the stocks went up, so we're okay, but it just feels late and extended and tired to me. And I'll let you know if things reverse and accelerate. But so here's my take. This is my hedge fund that I just showed you, and I want you to help you build yours. And stocks do go down, and if you make money in up and down markets, I think psychologically it's going to be a great thing for all of us. So I'm going to see what if it works. And I hope the answer is yes. So far it is. Most of you haven't seen big bear markets, and please do me a favor, refer your friends, and stay tuned. Next, Wall Street bets. And so, I spent time on Wall Street bets. And there was just one report from, and I forget who this was, I apologize. But make a long story short, GameStop, if they announce something regarding NFTs that is, obviously harder than a pistol with this Constitution news and what have you, the NFT world's exploding. How much is real versus promise? How much have we priced into the present? I think is a great deal. But from a recent show, I talked about with the price at 213, GameStop was at 177.51, the 200-day moving average. It's moving up. And the volume is picking up in the up days. But in the case of GameStop, the fundamentals really don't matter. But I want you to be alert that if you see some great news on NFTs, yep, it could go north. It could absolutely go north. If it yawns on that, then I'm going to be more concerned. And so my take is hold GameStop for now, but be ready to sell a third. And I know the holders hate that, and they think I'm a shill for the hedge funds, and I am not. But if you're in anywhere below 177 to 200, then you've made money, and I want you to keep the money. And I'm telling you, when these things roll over, they roll over pretty much the same way every time. And a close below the 200 day is going to be the first signal to sell a third. And I'll let you know. Podcasts of the week. This is Pivot, and I got the link in the show notes here. Prof G at 20 minutes. He talks about Apple buying or Nike buying Peloton, and that was before the recent swoon in the stock price, and it makes a lot of sense. Affluent, technically adept people, you have their attention for 30 to 60 minutes every single day, and Apple wants to be part of that. So it makes sense to me, which is why I wouldn't be shorted, especially at 54. Square buying Twitter, and Jack Dorsey becoming the CEO of one company as opposed to two. He's the CEO of both right now, and becoming the Alibaba of the US, and the super app makes a lot of sense as well. And stay tuned for that as well. So if you own those stocks, I just want you to have that in the back of your mind. And please check out those podcasts. I listen to them every single week, and I think they're terrific. All in, mentioned it before, Jason Calacanis is the host. At 10 minutes, Chamath Palihapitiya, who sponsors a number of SPACs, including SoFi, said 3 different times, the stock market's at new highs, inflation's at new highs, the economy's at new highs, and the 2 smartest people, and arguably of our generation in the US, Bezos and Musk, are selling stock. Now, them selling 10% stock is we can't relate to it because of their massive wealth. But bottom line is you sell stocks when you think they're going down, not when they're going up. And he can make, in the case of Musk, they can be posturing about taxes and what have you, but he's still selling the stock, and he's selling the stock in November. I said this on Twitter. He's selling the stock in November. You wait till January 2nd, you push the tax out another 15 months. So he might be seeing something that we don't, and just it's cautionary to me. And then at 106, Jason in particular talks about China, Taiwan. That's my I think China attacking, trying to annex Taiwan again is the gray swan out there that could really whack things. And I think the EUM ETF that I own is perking up enough to tell me that something might be going on in that regard. And there's other bad problems with China as well in their real estate market. We'll talk about that pretty soon. Reporters of the week: uranium squeeze on Wall Street Bet pointed to this Wall Street Journal story in the op-ed piece. Nuclear power is the best climate change solution by far. Pretty emphatic and pretty straightforward. Andrew Filat and Henry Miller. And greenhouse gas emissions are 1/700th those of coal and 1/4 those of solar. So the drumbeat is growing for nuclear to be more accepted, in my view, which is good for uranium. The Economist, which I wish they would put their reporters' names on them, but they don't for whatever reason. But there were 2 articles in the November 13th issue: The Discreet Charm of Nuclear Power, and Will the Climate Crisis Force America to Reconsider Nuclear Power? And I think that's absolutely the case. Red, white, and green is this chart that they used, and they show that support for Republicans has always been pretty strong, but for Democrats, it's been growing over the last 3 years. And so that we went from 37% approval to 56% for Democrats. And young people, they don't know about 3 Mile Island and Chernobyl. So it's becoming. I think uranium is ESG. I tell my share scoops people that all the time, and I think it's inevitable that it becomes a bigger part of ESG going forward. Bloomberg Green writes, China's climate goals hinge on a $440 billion nuclear buildout. They're building 150 new reactors in the next 15 years, more than the rest of the world has built in the past 35. So, I mean, this is coming in my view. This is from Dan Murtaugh and Crystal Chia, the reporters at Bloomberg Green. And now that's not going to happen tomorrow, but all of those plants are going to be signing contracts eventually for uranium, which is going to be scarce and going up in price, in my view. This is the other part of the China story that I've been watching and talking about with you folks. The shares of Chinese developers, this is in the Business Insider, Donnie Kwok and Anne-Marie Rowntree, and shares of Chinese developer Kaisa and their units suspended as their debt woes mount amid fears of contagion from Evergrande's crisis. So Evergrande has run into some severe liquidity concerns, and now it's starting to spread to the rest of the real estate market and the other developers. So shares were suspended Friday. The company said it's facing unprecedented liquidity pressure, and among Chinese developers, Kaisa has the most offshore debt due over the next year after China Evergrande. So they plead for more patience to solve their liquidity issues as concerns mount. That's from Reuters, Josh Horwitz and Brenda Go. And from Business Insider, Huling Tang, economic slowdown would have global consequences, says Yellen, amid concerns that Evergrande's woes could spark a financial crisis. So this is becoming more pronounced, more prevalent. We've been talking about it from the back pages of The Economist, and now it's starting to get to the front pages of the Wall Street Journal and other sources. So this is also from The Economist recently. Evergrande is not the only looming danger in China's financial system. Chairman Xi, the head of the Communist Party, is may succeed in averting a bad debt crisis by reasserting state authority, but it creates dangerous distortions in the future. So it could happen. I think it's unlikely. And my take is, first it was Evergrande, and now it's Kaisa, and now it's Country Garden, and now it's Vanke. And I use the COVID example. I'm not going to panic, but I'm not going to ignore it. And so this could be a contagion. And real estate is 30% of the Chinese economy. And we've seen this movie before, 2008 through 2010, The Big Short around here. When debt unravels, it's very, very painful. And the deflation that occurs, I think, is going to be painful for the Chinese, no matter what extreme measures the Communist Party can take to stem the losses. In the Wall Street Journal, James McIntosh writes about on the inflation surge, the Fed is running out of excuses. And investors still buy the story that inflation will go away, but the risks are rising that it won't. And then I just look at this median consumer price index chart. And I'm not an economist, and I almost never, I would never take a top-down view and make an investment. I always look at what's going on on the ground level with individual stocks and groups. But as James points out, inflation is broken out through prior resistance. The trends tend to persist, and I think James is right. And I mean, this is 30 years of history, and we're blowing through it. And it just doesn't make any sense that that's going to reverse anytime soon. So my take is, the market presents inflation winners. You don't, and I don't need to guess ahead of time. So we're in copper, we're in agricultural, we're in uranium. And frankly, we were in them before inflation was being talked about, because the market was anticipating it. And so I just think it's better to do it that way than to try to be an economist stock picker. I don't think they're very good at it most of the time. My charts and tweets of the week, James Bianco. And this is just an interesting case study where Tesla was included in the S&P. They had to kick something out, and Apartment Investment Group, AIV, after it was kicked out, outperformed Tesla, which is no small feat. Tesla's been a horse. So the fact, but I just it goes to the point that how much good news is priced in, and it's a great question to always ask yourself. Does it feel like that everything is just about here, and should I go look for other places to go? He also talks about this is James Bianco again. The Australia said this is how yield curve control ends. This is his commentary. It blows up in the central banker's face, and then the central bankers go to great pains to explain why this is what they planned all along. And so this is the bond yield for the Australian market, and it went from 0.1% to 1.8. It looks like in a month. And my point here is if U.S. rates do anything like this, and the Fed says, oh, that's what we try to do, it's going to be a lie. And then number two, 1.7% on top of 1.5 is 3.2. And there's no way the market goes higher with rates doing that. So I'm not saying it's going to happen, but watch for it. And if you see breakouts, and I'm sure going to be looking for them, breakouts in yields that are substantial, you're going to see breakdowns in stocks, especially high-priced tech stocks. And so my take is consider what's priced in, and the charts will help, and I'll help you with the charts, and listen for lopsided commentary. If there's too much consensus on one side, you and I will lean the other way, and I think we'll be better for it. My newsletters of the week, the Bear Traps Report, it's just a graphic illustration of the Chinese situation. The top two Chinese developers, Country Garden and Vanke, their dollar bonds are getting crushed, which means that people think they're not going to get paid back, and they're probably right. And look at the price action on these. So Larry McDonald and his team does great work. So my take is China's slowing is neutral to bearish for the U.S. Stocks. It can't be bullish. I can't come up with a way that any of this is bullish. All right, folks. That's the show. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Follow us on Twitter at Bakes Takes at Bakes Takes _ and other social media. Please use your voice memo app, tape your questions, and email to bakes@bakestakespodcast.com, or write in if you'd prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Have a great week. This is Bakes, and for much needed levity, a double shot of Anthony Jeselnik, who I think is one of the funniest stand-up comedians going. Kissing Butts and Taking Names is a recent podcast of the Jeselnik Rosenthal Vanity Project, JRVP, Junior Vice President. Erica does it better, I understand. But also, Anthony Jeselnik Roast Pete. It's on the Pete Holmes show recently on YouTube, and please check that out. Hope you have some fun, and happy Thanksgiving to all of you, and God bless you. God bless America. See you soon. Bye now.